done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Not different from what he said the last time, but there were some points that are shifting. Joining me now, Wharton School finance professor emeritus Jeremy Siegel. Professor, a pause after a trio of cuts. Was that the right move?
Yeah, I mean, it was widely expected to be the right move. Liz, I still think 2 more cuts are appropriate, sometime this year to get down to the low 3s, but everyone expected a pause at this point. It was kind of a nothing burger type of a news conference. If anything, however, I think it tilted a little bit on the dovish side, if I were to look at it. He talked about progress on services. Inflation as being important. He talked about looking beyond the tariffs, not being overly concerned about that. Did talk about potential weaknesses in the labor market. Did not get panicked about silver, gold, the dollar, which he refused to comment on, or some of those other inflationary factors. So net, I would say it's slightly on the dovish side, but truthfully, not much new information from the December meeting.
So is higher for longer still the right framework if that's what we start to see here in this so-called cycle?
Well, I think that, the March meeting, we're going to get a lot more. And finally, hopefully without another government shutdown, we're going to have full data on 2025 and the first quarter of 2026. We'll be able to make a much more informed decision to see whether, the strength that we saw in the 3rd and 4th quarter really continue into the new year or not. So in a way, he's leaving all the options open. And as I said earlier, I still think a couple more cuts are appropriate this year, but clearly no commitment was made by Powell.
Listen, when we look at exactly what the market expects, Fed funds futures for March, I'm looking at them right now, still just about 13% odds of a rate cut. April's not much better. I mean, we're still seeing for April under 50% by a long shot. It's at about 30%. So the first time we could possibly see a cut is June. So is this a pause policy? Is it policy discipline? Or is it policy paralysis, considering you now have, for the second time, 2 Federal Reserve voters dissenting, which is highly unusual because before that, it was 30 years or so since the last time we saw this kind of dissent?
Yes, remember, there's those probabilities you put up are what the data we have now. You have one really weak employment report, and they're going to skyrocket. So, that's not a pre-planned look and saying, oh, well, we're not going to get one in July or June. That's just because, honestly, the employment data looks very good right now. But it certainly could change if we see weakness coming into the market. It could change if we see inflation slow down. There's a lot of those probabilities are based on a lot of incomplete information at this point.
Well, I have to ask you, you say the jobs data still look pretty good. Today, Amazon announced it was going to cut 16,000, or they confirmed 16,000 corporate jobs. Since May, it's been something like, I don't know, we started to see green stick fractures in the number of jobs that were created. The bar chart certainly shows that. And then suddenly the jobs market appears to have a couple of cracked ribs. Does it not? So, I mean, we're waiting on a second revision for November, but it was already downwardly revised by 8,000. I don't know. I mean, this is starting to look a little squirrely. So to my question here, these are embers. Do you wait till it's more of a fire that becomes out of control before you start doing something?
Well, there's the most current job data is the weekly jobless claims that comes out every Thursday. We're going to get it tomorrow morning again. That has showed really strength. And you're right. We see the Amazon layoffs. We saw UPS layoffs. Why aren't they coming into the jobless data? That has always been my go-to for the current state of the jobless market. So unless those data are being distorted, and by the way, those are not federal, they're compiled by the state, and we did get them throughout the last government shutdown. They're not really showing that people, if they're being laid off, are going and collecting their unemployment insurance, which would be, extraordinarily unusual. We have challenger layoffs. That comes in with a lag, whether the UPS, Amazon will come in, next week or the month after that. We'll have to wait and see. But the jobless claims data, the go-to current data, still remains very firm.
Listen, he talked about independence of the Federal Reserve. He talked about the credibility of the Federal Reserve. But specifically, he was asked about why it's important for the Fed to remain independent of any political voices. And this was where he got really earnest. Listen, then I'll have you comment.
It's just an institutional arrangement that has served the people well, and that is to have a separation between, to not have direct elected official control over the setting of monetary policy. And I think if you lose that, it's, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
One of the voters, Professor Christopher Waller, is in the running to be the next Federal Reserve chair. He was one of the dissenters. He wanted to see a 25 basis point cut, along with Stephen Myron, who moderated his previous 150 basis point cut down to 25 as well. That kind of speaks volumes. But did Christopher Waller just really show how badly he wants the job? Or do you think that he really believes that we should, even as we see stronger durable goods numbers and a really good growth number in GDP, he thinks that we still need a cut?
Knowing Chris Waller, I think he thinks we need a cut. I think he sees softness and potential softness in the labor market and sees that inflation is on the right path. I do know that it could be interpreted the other way, but I think he is an economist that is looking out for the best interest, and he does believe in a cut. Marin, by the way, he was for 50 and went down to 25, getting closer to maybe what he wants. I think he's a fine economist and a different voice that I think really should be retained, not go back to the White House at the Fed. We need as many different voices as possible. I think that serves the American public very well.
Well, he was really earnest and very solid when he said that. It'll be interesting to see what happens. Jeremy, it's great to see you. Thank you so much.